start now. So, okay, this is the fun update call. It was meant to be on December the 18th, guys, but it, didn't turn out that way. It is on December the 19th. So I should say it was meant to be on December the 18th, and it turned out to be on December the 19th. And you know what? Lo and behold, here we are. So thank you so much for joining in, guys. All right, let's continue on here. Okay, so what are we going to talk about today? Expectations of what we think the market's going to do in 2025, right? What do we see? Where do we see the stock market at? We're going to kind of talk about that. No one has a crystal ball, guys, but this is just, educated guesses and saying, hey, listen, this is where we think things will be, right? And this is based on other people's research as well, right? So we take a look there. We will take a look at some of our outstanding positions, and what we're going to be looking at in the next few weeks is interesting, though. You know what? Yesterday was a big announcement from the Fed, really kind of shook the markets just a little bit, not crazily. So we'll talk about that a little bit as well. Okay, so 2025. Stock market has gone up the last couple of years. Absolutely. We had a terrible 2022. And, many of you maybe recognize that, just how horrible that year was. And then 2023, much better. We had, high inflation rates, and, luckily those seem to be all but under control right now. And as we see here, S&Ps have been up about 70%. NASDAQ up 101%. Like, think about that. Like, if you say the S&P is on average, the S&P goes up about 10% a year, then yeah, like it's actually it's crazy that it's up 101%. So yeah, like that's a considerable amount. It's up over the last 2 years, right? So just give me 1 second, guys. I believe David Jarvis has not received the link. I'm going to just loop him in. Just give me 1 moment. I really apologize for doing this to you guys. I'm just going to loop him in really, really quickly here, and then get going. Give me this 1 second here. We are going to go here. Let's see. Sorry, guys. Just give us 1 second. Apparently, he doesn't have the link. I don't know why he doesn't have the link. He just doesn't have the link. All right. And now he does have the link. All right, so I'm going to get back into this, guys. Many apologies there. So where were we? We were talking about the S&P 500 going up on average 10% a year, and now we've seen, it's 70% up since October of 2022 and 100% up on the NASDAQ since October 2022. So yeah, it is considerable. So a lot of ground has been made up for over the last 2 years, right? Now, granted, if you lost, say, 30% in 2022, to make up for it, you need to make up like 60%, right? So there is a little bit of making up for it here to do. But again, very interesting. So in other words, the S&P index has increased more than 20% in the past 2 years. Yeah, but that's at a very low point, right? So again, we can, in my opinion, I think the reason for this, guys, is that we have changing inflation and interest rate expectations for the positive now. We have the acceleration of AI and EVs and like basically technology into the economic environment as well. And now we have what's supposed to be a bullish type of president that's all for business. So we'll see what happens. So again, those, and obviously I have brushed over this. I've brushed over this. Very much so just now. But again, we do see and have seen some catalysts for why this may be, why certain people are feeling this way. So for 2025. Wall Street predicts S&P to grow by 8% from the current level. And I don't know if you've noticed, but if you've been seeing Bloomberg News or other news sources, there's a lot of people saying, or pundits or gurus or elder statesmen, whoever you want to call it, say yes, well, the S&P will be here, right? I think I heard this morning they think S&P will be at 6,500. Okay, well, That's nice, but no one has a crystal ball, right? I'm a firm believer that, you pick good companies and you do whatever the strategy you want to do, either buying them outright or writing options, et cetera, et cetera. I think we all believe in doing a little bit of both, and off we go, right? That's going to be likely the best, that's the best outcome for me, right? So, but again, no one really has that information, right? These are all just best guesses, okay? All right, let's continue on here. All right. So David said he's on. He's on in secret and listening to me. So I can promote him to panelist if you would like. But nonetheless, he's here. I'm going to promote David to panelist. See if he accepts my offer there. But yeah, we'll continue on here. So what is this showing? What is this showing us, right? This is where each of these investment houses, Oppenheimer, Wells Fargo, et cetera, where they think the S&P is going to be as of end of 2025. Good afternoon, David. Thank you. Hope you don't mind. I invited you to be a panelist. And we can see here, like all these things, just take them with a grain of salt, right? But Oppenheimer 7,100. Well, Nasdaq's at about 57, 5,800 right now, right? So, okay, it's a good increase. But what about BCA Research? Who the heck are they? And why did they think that the market's going to be down like 15% this year? Like, what's going like, what does BCA know that Oppenheimer has seemingly ignored? I don't know. This is a rhetorical question, right? But the point of the matter is that nobody knows where this is going to be. And, I can tell you, if you're coming in the middle of the pack at 6,600, okay, well, that's nice. That's almost exactly 12%, which is almost exactly the average, which, that the S&P goes up, which is 11%. And maybe you said, okay, well, it goes up 11% on average, and maybe we have a fiery interest rate environment and a pro-business president, so I'm just going to add an extra 100 points. I don't know if it's that simple, but it certainly turned out numerically to be. But at the end of the day, these are just estimates, and yeah, it's just guidance. I'm not saying that anyone is any better than the other. David, any comments about this type of forward thinking? Like, you have to admit, like, these guys are opining on where 500 stocks in aggregate will be in 12 and a half months time from now.
No, it's getting very hard for these people to make forecasts because they're making more and more robust assumptions about earnings growth and nobody really understands what Trump 2.0 is going to be about yet. It's just too early. So yeah, even though there's a relatively narrow dispersion from 6,400 to 7,100, notwithstanding Stifel and BCA research, the general feeling is that what is going to happen? And we really won't see until 6-8 months into the new administration. So by June, it'll become clear what policies will be allowed and implemented in the new Trump administration.
Yeah, absolutely. And some of these, I think the majority of these are nice safe bets in around 10 to 12% increase for the year. But again, it is anyone's guess. But at the same token, there's very like the outliers. If you take out the outliers, could be a decent time for like, written options, from the perspective that we know that written options, as an overlay works kind of best when you don't have these giant swings up and down, right? So maybe good news for that type of business. All right, let's continue on here. So, BCA, yeah, 26% decline. Fair enough. We'll take that as an outlier. But again, nobody really knows. I would, when I look at these types of analyses, guys, I basically take out the outliers, because I don't think I don't know if they add all that much value. Stifel predicts that the extended valuation in S&P index suggests an imminent correction of 10 to 15%. Well, we got 3 of that percent yesterday, so who knows? But also that prediction was in 2025, and it is still technically 2024. Okay, let's move on from here. Goldman Sachs, again, this is some bull predictions, 11% next year. Again, that's right on target of the average that the S&P has been pulling for the last 50 years, right? Driving factor behind Goldman's prediction is continued expansion of the U.S. economy. And again, that's kind of a Trump 2.0 presidential trade, if you ask me, right? And it was growth for 2.5%. And I think growth came in at about 2.9 or 3% yesterday on the at the FOMC meeting, right? So again, it's all very close to each other here, right? Morgan Stanley also 6,500 due to interest rate cuts from central bank combined with economic growth. The issue I have with interest rate cuts is that they say that your impact period is between 6 and 18 months, and that's a bloody long time, right? 6 to 18 months is a 300% range, right? It's not short. So it's very difficult to predict where, what really that impact is and when. Some research houses predict the economy to perform well during the first half of 2025 and headwinds in the second half. Maybe, don't know. But again, these are just some predictions. Some things the value you can take away from this is that, you don't have kind of this few more ideas. So like, and we like, to tell you the truth, from the fund perspective, guys, we like this. And I'll say why, is because, as I said before, writing options, it works well when there is range-bound trading. Range-bound trading with some volatility, in my opinion, that's a pretty favorable environment to operate in, right? When you have severe declines and, kind of hyperbolic increases in stock valuation, it's a much harder kettle of fish to trade in when you're dealing with an options overlay, right? So I kind of like this arena, right? If these are the predictions, I'd be kind of happy with these predictions. I wouldn't be happy with BCA or Stifle. I don't like them at all from the predictions perspective. But again, even at this top end of 7,100 from Oppenheimer, you know what? That's I think that there's some value to be added with an options overlay there, right? Here you can see the price to fair value of Morningstar's U.S. equity. So price, like the market price, over the fair value, right? Which is kind of like, I'm going to assume that's kind of intrinsic value. You can see that, yeah, there's a certain amount of overvaluation in the market that started. Like, look what happened in 2022 when the markets fell apart due to like soaring inflation, right? And slowly 2023 got like way better, and then 2024 even more, even better still. And now we're at the price of fair value is it's over 1% here, right? Now, is history going to repeat itself like in 2018 into 19? Well, that you have to kind of figure out what happened here, right? What happened in 2018? Well, you had that inverted yield curve in around here, right? And that threw things for a loop to a certain degree. Now, granted, that also happened, I think, towards the end of 18. So this, you could take off a little of that as well. But again, and into 2021 and 2022, not only did the price of things go up, but also the price of stocks went up after COVID. And here you see kind of the decline here, right? So, I'm not sure. I don't think I'd be very well suited to apply like quote unquote technical analysis, say, oh, you're making lower lows here. No, this is not that type of chart, guys. I think this is the type of chart to say, okay, you know what? When this kind of ratio is over 1%, which is this red line, hey guys, there is some kind of propensity for a downturn, but again, you have to have other catalysts as well here, right? And you know what? We are okay with that. Like days like yesterday, we are okay with those types of days. It gives us opportunity. We saw a VIX number yesterday float from like, what is it, mid-teens or mid-low teens up to like 28. We don't mind that type of behavior, especially we see a little bit of a rebound today. So again, all within that kind of to continue on that theme of, we like to see that kind of range-bound trading. Okay. All right, so these are some of the Morningstar predictions. We can see here. I've kind of talked through these already, and you do see that there is oftentimes it does kind of retreat back after that ratio is at such a high, and I mean I would point ourselves also to like I think a lot of next year is going to have to do with, as David was rightfully saying, Trump 2.0. And I think a lot of Trump 2.0 revolves around tariffs, right? And we don't know what these things look like. We don't know why they're like the reason why they're being deployed or potentially on different countries. Those decisions may be different for each country, not for each country, but there may be multiple reasons why tariffs are being levied or proposed to be levied. But again, textbook economics says that tariffs are not good for the economy, right? But again, are we in textbook times? I would argue that perhaps we are not, right? David, what about the concept of tariffs? Any comment from you in terms of, we've seen a president that doesn't have the ability to levy tariffs just yet, but has certainly talked about them a whole heck of a lot. What do you think the impact of tariffs will be, going into 2025?
So it really comes down to how tariffs are actually implemented and used. If they are used on a broad way, I think they're going to be very disruptive and will definitely trigger inflation. If you take a look at if you take a look through economic history where they've implemented tariffs, significant tariffs, etc., it definitely has created inflation. Argentina with Miel or whatever, when he first came to power, he did certain things that imported inflation, etc. But the alternative is what's called the surgical use of tariffs. And the people who are behind and making some suggestions and part of the decision-making cabinet of Trump are very much in favor of precision tariffs. And so I can definitely see for sure at a minimum the use of precision tariffs. An example of a precision tariff would be Canada has a highly restrictive set of marketing boards, milk marketing board, etc. And a precision tariff would basically be to uh, put a 20%, 30% tariff on certain goods and goods related to our dairy industry until Canada gets around to dismantling them. Or you apply a tariff on aluminum or steel importing into the States, and you say it remains there as long as Canada maintains its restrictive marketing boards. So I definitely do believe that we're going to see surgical tariffs. The issue is it going to be extended to something broader and used indiscriminately. The problem is, as every Canadian knows, we are facing and listening to the rhetoric about I'm just going to blindside and pound the crap out of Canada. Unfortunately, it's not a bad strategy for Trump to do for Canada, because if he can stand up to the world and announce, hey, this is our closest trading partner, we just pounded the crap out of them. Guess what? If you don't toe the line, you're next. It's a nice, I hate to say it, we are an excellent punching board, and it does not help that our political problems are intractable, and everyone in the administration knows that Canada has a lame duck prime minister, and that the federal government is completely and utterly in disarray, and that Canada has no voice to organize and speak coherently and effectively. Everyone in the Trump administration
Well,
knows
unfortunately, David, we're being called the 51st, we're being called the great state of Canada by Mr. Trump.
Yeah, he's just doing that to bug everyone. But
He's doing a very good job.
I,
Yes.
I so for
Headed
sure
by
we're going to get
Governor
surgical
Trudeau.
tariffs. The issue is, do we go out do they go out and literally impose broad-based tariffs, which will definitely create an import, at least on a temporary basis, inflation, and then it triggers whether or not the U.S. Feds respond by raising interest rates, or at least defer any further cuts in interest rates.
Well, on the other side, if we are considered the great state of Canada, they can't levy a tariff against a state.
Hey, Canada has
Just
import
saying.
tariffs between provinces. Um, and we actually need to negotiate a free trade agreement within Canada. What can I say?
I think that's the subject of perhaps another call.
Or or another election.
Another election, maybe a series of calls, et cetera, et cetera. But all right, so let's continue on here, guys. So our fund, I think for the year, these are unofficial numbers. We're heading up to about 18% annualized, not annualized, 18% return for the year so far, which is not bad considering a lot of, in the first year, brand new funds, which this was, takes several months to actually fully deploy. Right, so we're actually very happy about that, and we've we'll send you some stats around that once the year ends off and we have some finalized numbers. But all in all, we're pretty pleased here. In terms of our exposure here, guys, we're a little underweight on Alphabet, a little underweight on Amazon, and Apple as well. And sometimes, and I'll tell you why. A lot of the time, stock prices run away on us, right? And we don't necessarily want to be chasing those prices. We're not chasing, we're not chasing puts. We're not chasing going long these stocks. We will wait, right? And how long will we wait? Well, we did some deployments today after the market went down so much yesterday, and we'll continue to do so, right? We're not going to jump into stocks where we think there are at the top of their cycle, right? So we've been very pleased with some of our performance in some of these stocks, but generally speaking, this is what we look like right now. Well, actually, not right now, as of a couple of days ago, on the 13th, actually. So we look similar to this. This is not identical, but again, we are moving towards our desired exposure, and these things are dynamic, right? Like, for example, Tesla went up a whole heck of a lot over the last few weeks, right? Apple has stayed a little bit stagnant, but has been at the top of the trading range, and volatility has been low. So there's reasons why these positions are they are under that current exposure level, right? Of course, if you have any further questions about that, happy to field them. We continue to kind of trickle in our exposure to Bitcoin through IBIT, which is the ETF. That's likely the riskiest we're going to get to there, and we're going to keep that to a minimum for now. Bitcoin, it is seemingly to be an ally of Trump's, but of course we want to look at other underlying factors outside of being a politically based one as to why to buy Bitcoin related type of securities, right? And there's a story behind Bitcoin. We do believe in it, but again, the allocation that you show will also kind of tell you how much we feel comfortable with, right? As opposed to like an allocation to an NVIDIA or Tesla, where we have a little bit more, and Microsoft, we have a heck of a lot more conviction in those positions, right? But again, this is supposed to be an alpha fund, and indeed it is. We are, we want this to have a significant growth tangent to it, and these are stocks that certainly represent that in our opinion. Let's continue on here. So again, yeah, so we have, as of last week, 16 puts written, current put exposure of AUM, so 6.7% were basically written puts that if they got assigned will be about 6.7% of our portfolio. We have about 80%, the 79% that's in long only, which is good, because despite what people may hear, like, you want to be long stocks and you want to be short options both concurrently. Unfortunately, they both have to equal 100%, right? But there's a value to be long stock, and there's a value to be short written put sometimes, right? So we have to balance that, and that's part of our daily discussions on how to manage this product. Again, we keep our average expiration days to expiration under the 30-day mark to capitalize on Theta as best we can, and yeah, this is an interesting number, guys. Total value of options premium received as a percentage of AUM, right? That's 8.33%. Not bad, in my opinion, right? Not bad. So, this is premiums that, if we had not applied an overlay, this number would not be in existence. It wouldn't exist, right? So, keep that in mind. And this provides a nice little icing on the cake, and then some. I wouldn't say icing on the cake, but a significant layer of the cake. In my opinion, in almost any investment mandate as appropriate, right? Okay, so yeah, just some other information here, guys. Yeah, this is eligible for registered accounts. Omar, who sends the regrets for this call, I'm sure will be in touch with many of you as RSP season hits us and is up in the running for the next 60 days after the year end. So he'll definitely be in touch with some of you there. Ending off which is looking to be a fairly strong year. This is a growth vehicle, and our fund code is CCI 705. Awesome. What to look out for? All right, January. We do have this thing called a January effect, which is a lot related to like this general exuberance in the market of a new year, new me, which I never really got the hang of understanding. But sure, if it works for you, it works for you, right? But again, it is a phenomenon. We do see certain upticks in January, and we are looking to see what that tone is. Now, of course, overlaid on top of that is the fact that Trump is going to be taking office, I believe, on January the 21st, right? So yeah, we're gonna look for that, and we're gonna see like what those first few days in office are like, right? What type of, he's alluded to what he's going to be doing, but he doesn't really have all that much power to do it right now. But on January the 21st, well, guess what? He does. So let's just see what that looks like. As per Thackeray, which is the seasonality kind of guy, that's a specialty. Average gain of 1%. 59% of the time. This bodes well in terms of option pricing as to, what we need to look out for, how much risk we can take on the portfolio, given it is a growth portfolio, and we're going to proceed accordingly, right? And again, NASDAQ, very strong performance in the NASDAQ at 2.4%. When you see these numbers, guys, don't be like, when you see 1 and 2.4%, that's per month, guys. Even at 2.4% a year, if you compounded that, that's going to be damn near 30% annualized return. And if you were to make that indefinitely, you'd be literally the greatest portfolio manager that ever lived. So when you see this type of stat, it's a pretty strong stat, right? Now, I'm not telling you that the whole year is going to be like that, because it is explicitly saying it's not going to be like that, right? That's because this is just for January. It's not saying any other month, right? But again, that's a pretty strong stat. So we'll trade accordingly when it comes to kind of the seasonality that we apply to the portfolio, okay? And again, anticipated rate cuts both Canada and the US. That was a little bit of a catalyst yesterday, guys, where we saw, some, not one, but I think 3 or 4 hawkish comments coming out of the FOMC meeting there. Or I shouldn't say hawkish comments, but I'll say at least hawkish positioning, right? In terms of how many people voted for cuts, how many didn't vote at all, how many people wanted to didn't vote at all, but how many people didn't want any cuts for yesterday. I'd define that all under hawkish positioning, right? And that could be that could be a bit of a headwind as well. But we'll see what happens into January. I believe a 25 basis point cut is generally expected across the street. All right, guys, if you have any questions about this product, this Omar Khan, I'm sure you all have his information. If not, he'll be reaching out to you. There's myself and David Jarvis from Corton Capital. And yeah, we thank you for all your support for the last 1 year. We'll be 1 year, I think, in second or third week of January in terms of fund launch. And we couldn't be happier that we have this 1 year under our belt. And we have, you to thank for it. Obviously, we have obviously seeded the fund, myself and Omar, and close friends and whatnot. But again, most of this is due to your support, guys, and we thank you very much. We look forward to many years of good times ahead. Okay, this is our mandatory disclaimer, guys, which I've kind of kept on the screen as I've been talking. Feel free to read this at your leisure. And with that, I wish you a wonderful Merry Christmas and a Happy New Year. And we will see you all in 2025. David, any closing comments?
No, I hope everyone's enjoyed the year. It's been tough, good things, bad things. And I really hope that everyone has a wonderful and prosperous 2025.
Absolutely. Thank you, David.
Thank you.
Guys.